Get ready to rumble. Schilling Show Unleashed on the Seven Thunders Media Network. Former city councilor, husband, father, and community watchdog. Your host, Rob Schilling.
Welcome to the Schilling Show Unleashed Podcast. Remember, your direct support makes our show possible, and you can directly support this podcast by visiting schillingshow.com and then clicking on the Patreon banner at the top of the page to make a monthly contribution. We appreciate your support. The Schilling Show Unleashed podcast welcomes Todd Sheets, a corporate accountant and investment banker and author of the new book, 2008, What Really Happened, Understanding the Great Financial Crisis. And Todd Sheets, thanks for joining us today on the Schilling Show Unleashed.
Rob, thanks so much for having me. I enjoy being with you.
You mentioned in the beginning of the book some historical perspectives, Hamilton, Jefferson, Jackson. Give us an indication of why those individuals are influential and important in this discussion.
Yeah, I think there's two very important aspects. One is that there was this debate between Hamilton and Jefferson at the very beginning of the country, which essentially boils down to a debate we're still having today, and that is, what is the proper role of government in the American economic system? And Hamilton was a very big believer in kind of the British model, even though he fought with Washington against the British armies and that kind of thing in the Revolutionary War. He was kind of enamored of the British mercantilist model, and he was very much in favor of what we might call a more activist government role. He supported the idea of a national debt and the idea of the first Bank of the United States, and then by extension, the second Bank of the United States, which was modeled off of the first bank. Now, on the other hand, we have Jefferson, very much a believer in a more minimalist, or what today we might call a limited government model. He was very influenced by Adam Smith's ideas, and so there was this big conflict and contrast between the two of them from the very earliest stages of the Republic. Jefferson kind of ended up winning out more or less during his first two terms, or his two terms, beginning in 1800. He brought the national debt down significantly. He worked against the first Bank of the United States, which was then closed. A second one was opened. And then into the picture in the late 1820s came Andrew Jackson, kind of the first, to some extent, president of the people, with a very strong agenda, which was very much along the Jeffersonian ideal, even though Jackson at that time was a Democrat. And Jackson fought very hard to close the second Bank of the United States and then to pay off the national debt, which kind of kept the country on this limited government model moving forward. So that was one key aspect. The second key aspect was, even though Jackson's presidency had enormous historical significance with paying down the debt, closing the second bank, kind of the first president from outside what had been dominated by kind of the so-called Virginia dynasty before that period of time. Historians, in the 20th century historians, kind of painted the Jacksonian era as one of misguided policies that led the country into a downturn, a severe downturn. And they kind of tried to portray all of that as a mistaken agenda on his part. And it took over 100 years before that historical perspective was corrected by MIT professor Peter Timman, who showed in his book that, what had become the standard historical account of the era, at least from an economic perspective, was very much off base, and that if you instead of referring to anecdotes and selected information, you focus on broader aggregate information on the economy, it shows that what the historical account was basically inaccurate and not supported by the facts and that type of thing. In the book, because, I asked the question early on, why do we need an account of the 2008 financial crisis? Well, we're now, over a decade and a half past it. And that particular example showed that even the most important historical moments have often taken a very long time before an accurate accounting based on aggregate data, and that stands up to objective analysis and that type of thing comes forward to set the record straight.
So in looking at 2008, it's almost like it's ancient history. We don't hear it referred to much anymore, at least not by popular media. And I think most people probably think it was a blip. It wasn't a blip, was it?
No, not at all. I mean, there was, a 10-year period almost of directly related developments that led to what happened in 2008. We might say, in retrospect, misguided policies that led us there. And in many respects, an even longer period of time, where there was an increasing level of activism in the form of government attempts coming primarily from the Federal Reserve, but also with the Treasury and that kind of thing through the 90s and the 2000s, all of which, built up and played a very significant role in the crisis of 2008 also. And then there's the lessons that we take away from it. Similar to what happened with the Jacksonian era that we just talked about, I think we've drawn the wrong conclusions in general from what happened, and that leads us down a policy path that, has unfortunate consequences, and to some extent we're dealing with some of the consequences of those misguided policies that all stem from a failure to understand what happened here.
This was called the Great Recession. We had, of course, a previous generation, the Great Depression. We had the 1987 crash, the S&L crisis. What set 2008 apart from those other events?
So 2008 was the closest the country had come to a severe financial panic and what you might almost call, I don't want to be too extreme about it, but the beginnings of the financial markets starting to shut down in a way that was similar to what happened in the banking panics of the 1930s. And many people don't realize that. I mean, we have been through many ups and downs and, some stock market declines and these kinds of things here and there. But we hadn't really been close to the beginnings of kind of a shutting down of the financial markets. This doesn't mean they would shut down permanently or completely, which they didn't do during the Depression either, but they went through an extended period of time where there were a series of events that caused them to continue closing up and freezing up and kind of bringing economic activity to a significant, downward trend. So this is the closest we've come to that since the 1930s, probably the most dangerous panic since that point in time.
So a big part of this, one of the main components of 2008 and the crisis that we faced was the housing bubble. Again, people get lost in housing going up and down over the years, but what was going on? What was this bubble and what caused it?
I think the first thing to understand is that, and many people who think back to, were around before this all happened and, like I was and that kind of thing, they'll remember that housing in this country was considered an incredibly predictable and reliable and stable kind of investment market, kind of the foundation for most young people or young families, trying to build some wealth. I remember there was a great fund manager at Fidelity, the Magellan Fund, named Peter Lynch. He wrote a book, One Up on Wall Street, which was about picking stocks. And in his book, he made the comment, the first thing you should do is buy a home. Mm-hmm. And so there was this incredible level of predictability that had extended all the way back for over a century. There's national data that supported all of that. There were some ups and downs and some regional booms and busts, but people generally thought, housing was immune to kind of a national boom and bust kind of period. But what had happened beneath the surface was that beginning in the late 1960s and the early 1970s, two entities, first Fannie Mae and then Freddie Mac. Fannie was kind of rolled out of the federal government umbrella. It had been created back in the Depression to provide financing to the housing markets, but had played a de minimis role up through the late 60s. Congress wanted to be able to influence the housing markets, but they didn't want to have the debts that would be run up by an organization like Fannie Mae if it expanded its mission on the government books. They took Fannie Mae off the government books, turned it into a privately owned entity, created Freddie Mac in its image, and then gave them special privileges, which basically signaled to the marketplace that these are kind of government-protected entities. They're not on our books, so we're not directly responsible for the debts of these two enterprises, But if they ever get into a major problem, you can pretty much expect that the government will stand behind them and bail out the people who are providing loans to these two entities. Well, this gave Fannie and Freddie significant funding advantages relative to any of the other lenders in the home markets, and those advantages enabled Fannie and Freddie to grow substantially over the decades that followed. So if we went back to the late 60s, their share of the single-family housing market was below 6%, probably well below 6%. We don't have exact data on Fannie at that time, but they were a part of a group of government agencies that had less than a 6% market share. By the time we get to the 1990s, as they grew and grew over the decades following their private creation, they were up to well above 40% of the single-family home market and trending towards providing one out of every two loans, either directly or through a guarantee to another institution in the single-family market. So as I said in the book, they'd kind of gone from sleepy, quiet little beings down in the basement that nobody knew about and that didn't have much impact to where all of a sudden they had become the 800-pound gorillas of the housing markets, with the ability, for the first time, to influence national housing prices as a result of their policies. And in 1998, they decided to embark on a significant mission of expansion. Their growth rates jumped up dramatically from 1997 to 1998. 1997, I think they grew by a little over 7%. In 1998, they grew in excess of 15%, and then they continued with that accelerated growth pace for each of the next several years throughout what I call the liftoff phase of the housing bubble. If we go back and look at national housing price trends, which I do in the book, what we see is that in the 4 years before 1998, housing appreciation had basically been running at the level of general inflation, much as it had throughout the 100 years before. And then all of a sudden in 1998, coincident with Fannie's massive expansion and Freddie's massive expansion, we see housing prices jump up by historically unprecedented levels, housing appreciation to, I think it was 4.7% in that year. And then that too remained elevated throughout the next 4 years. So I think based on the analysis that's presented in the book, it's very clear that the housing bubble was triggered in 98 by Fannie and Freddie. So then we get to the early 2000s, the tech stock bubble that was going on, the dot-com bubble in the late 90s collapses in 2000. Later in the year, the Fed begins this historic response by dramatically lowering short-term interest rates, which they controlled. What happened was the Fed unwittingly made the mistake of pushing short-term interest rates down significantly below this historically elevated level of housing appreciation. That created a unique situation where you could significantly increase the returns on your investment in a home through the use of leverage, especially if you used short-term variable rate leverage. So that caused a massive surge of demand for adjustable rate mortgages, which were then being used to buy homes at these highly appreciating levels. And that brought another surge of home buyers into the market, not all of whom were more speculative, but many of whom were more speculative and looking for quick profits. And that drove the second phase, which I call the acceleration phase of the bubble, where housing appreciation jumped from being, let's just say on an average, well above 4% a year over inflation to well over 8% for the next 4 years above inflation. And it peaked at 10% above inflation in the final year of this acceleration phase, which was 2006. Now, just to put all that in perspective, in the 100 years before the bubble started, home prices had increased by about 6 or 7% over inflation over the entirety of that period, not per year, but over the entirety of that 100-year period of time. And now all of a sudden, as we get to 2006, we see a 10% increase in home prices over inflation in a single year, on top of 7 previous years where home prices had been running well above the rates of inflation. So that was kind of where the bubble peaked. In the next year, the Fed started normalizing interest rates and bringing them back up. And as they did so, we saw the rate of appreciation decline significantly. And then we entered into the beginning stages of the housing crash that lasted for the next several years thereafter, which then led us into the financial crisis.
The Schilling Show Unleashed podcast continues in a moment. Our guest is Todd Sheets, and the book is 2008, What Really Happened, Understanding the Great Financial Crisis.
Online at schillingShow.com.
SchillingShowMedia.com is your one-stop shop for websites, audio and video production, and photography.
SchillingShowMedia.com will take your project from conception to completion.
SchillingShowMedia.com is reasonably priced and highly professional.
Need a website for your business? Visit SchillingShowMedia.com.
Need a video created or edited? Visit SchillingShowMedia.com.
Have a photography or graphic design project? Visit SchillingShowMedia.com.
SchillingShowMedia.com is your one-stop shop for websites, audio and video production, and photography.
Visit SchillingShowMedia.com. That's SchillingShowMedia.com.
Schilling Show Unleashed.
Schilling Show Unleashed podcast, we continue with Todd Sheets on figuring out what happened in 2008 with the great financial crisis. So what was the point of them trying to pump up the value of housing? Were they trying to make Americans wealthy by virtue of their investment in housing markets?
Yeah, I think that's absolutely what happened. The head of Fannie Mae, when all of this began, was Franklin Raines, who was a very impressive person, came from a low-income background. He had seen his dad had been laid off, went on support, basically took any job he could take, but was a very hardworking guy, and actually, managed to buy lumber to build a home from scratch that he built by hand. And, Mr. Raines watched that process and saw how that helped his family build wealth. Raines was, an intellectually gifted person, went off to Harvard undergrad and grad, came out and had, various important positions in, I think, the Carter administration. And then he was a partner at one of the major investment banks and worked at Fannie Mae, and then came back to head up Fannie Mae right before this expansion took place. He took Fannie Mae down this path with the best of intentions, which was to do exactly what you said, which was to try and help low to moderate income families build wealth through homeownership. And unfortunately, as often happens, even the best and most well-intentioned plans, when implemented and when they start to interfere with the market interactions and mechanisms that have kind of kept a market working as well as housing had for so long before that, they often lead down paths, produce exactly the opposite results of the ones that were originally intended. And I think that's exactly what happened in this case.
This led us to the financial crisis that we suffered through. What were the stages of this crisis briefly? Where did it lead us, and how did we get out of it?
I think the first thing to mention is how does it connect? I mean, the way this connected was, if we go back in the financial crisis and comb through it the way I have, what we see is the thing that connected all of the institutions that started to fail as we got into 2007 and 2008, as housing prices started to implode and actually go down, the thing that connected all those institutions was exposure to home mortgages. What I do in the book is I go back and track market data, both the short-term lending market and the S&P 500, so that we can set up, as you suggested or asked about, the stages of the crisis. And what we see in early 2007 is the markets are generally benign and moving upward. As we move into the summer, we start to see the beginnings, what we might call the canary in the coal mine of what's coming in a couple of hedge funds, a Bear Stearns managed hedge fund, not Bear Stearns itself, which later went bankrupt, but a hedge fund that it oversaw, and another one run by BNP Paribas in France, both of which were heavily invested in U.S. subprime mortgages. Both of these hedge funds experienced severe financial difficulties. And so we see these benign, normal trends in the marketplace take a blip and a hit at that point in time. And so that's kind of what I call the awareness stage of the financial crisis. We clearly see a change in market trends, but we don't see the market spinning out of control by any sense or even becoming significantly stressed until we get into the fall. And in the fall, what starts to happen is these problems we see the public announcements that show that these problems are spreading to a much deeper and more significant level in the financial system. I think it's in October when Merrill Lynch announces, a huge multi-billion-dollar write-down of its assets related to the same issue. There was a long-running CEO of Merrill Lynch named Stanley O'Neill who was fired as a result of that. Citigroup went through similar problems. We start to see the stress stage develop. The markets still aren't in a state of panic, but the trend in the S&P 500 and short-term interest rates between banks clearly show that conditions have gotten a little bit worse. They kind of stay like this through the balance of 2007 and into early 2008 as a number of other less consequential firms go bankrupt. And then we get to March, Bear Stearns reach itself. Earlier the hedge fund failed. Now we see Bear Stearns on the brink of failure. And what happens at that moment is actually incredibly interesting from this perspective. The Federal Reserve steps in and for the first time in history provides bailout financing to an investment bank. This bailout financing enables the acquisition of Bear Stearns by J.P. Morgan. It keeps Bear from going bankrupt. And interestingly, instead of seeing the markets spin further out of control or leave the stress stage and go into a state of panic, they actually settle down a little bit. And the stock market comes, after trending down a little bit further, comes back up. Short-term lending rates kind of stabilize at a still stressed level, but clearly not panicked. And I think the clear message from all of that is that the markets have taken the conclusion away from this that the Fed and the federal government will step in and bail out any major financial institutions in danger of fail so that people can continue lending to these institutions with the expectation that they'll be bailed out. As we get into the summer, Fannie Mae and Freddie Mac, the institutions we were talking about a little earlier that trigger the onset of the bubble, they fail, and the federal government steps in and does what was hinted at all along, and it takes over Fannie Mae and Freddie Mac, provides an enormous bailout package, provides another one later to keep their lenders from losing money on this situation. And so again, I think the markets are, they're still nervous and stressed about what's happening as they clearly see the effects of the collapse of the housing bubble deepening and spreading in the system. But there's this sense that, the government's going to be bailing out these major institutions and protecting, those people who are providing short-term loans to these, enormous institutions. But then what happens is that we see an incredible political backlash to what's going on. Almost everybody hated the bailouts, except maybe the institutions getting bailed out. Mm-hmm. Many people saw it, not unreasonably, as a situation where Wall Street fat cats and other major institutions like the GSEs were getting bailed out, while average Americans, were losing their homes to foreclosure and that kind of thing. And others saw it as an inappropriate intrusion of government into the marketplace. With all of this political pressure going on, the people that are responsible for making these decisions at the Federal Reserve, the Treasury, and in the Bush administration decide to let Lehman Brothers fail September of 2008. And at that point in time, we go from this stress stage into a pure panic stage. The stock market drops significantly. I think it's down 30% by the end of the year. The short-term lending interest rates almost double from these already stressed levels. This is where we are clearly in a panic stage of the market, and everybody is very concerned about what other institutions might be allowed to fail. This basically revolves around a small number of endangered institutions that needed to be taken care of. And the panic conditions persist until bailout measures are then instituted for each of those institutions, which at that time, it included Merrill Lynch, who was being acquired by Bank of America, and Citigroup, those three institutions. And in January, we see the last of the bailout packages extended to protect those institutions. The short-term lending markets recover very quickly. I think within a week or two, they're back down. Interest rates in that market are back down to where they had been before Lehman Brothers failed. And shortly thereafter, we see the S&P 500 take off on a recovery that lasts through the end of the year.
I know it's a speculative question, but what would have happened, or would it have been a better course had we not gotten involved in the government and the Fed bailing out these institutions, instead letting them suffer the consequences of their actions?
That's a great question. I mean, I still wrestle with that question. I think under the circumstances that we were in and the paradigm that had developed of government involvement, which, as we showed in the book, we didn't talk about it here, but dated all the way back to 1987 and had built up through the 90s into the 2000s, always leading up to this point, there was probably no choice but to bail out these institutions to keep the financial institution from going into an even deeper implosion. But I also think by far the best thing would have been had we never gone down that path in the first place. That would have kept us from creating a series of expectations in the marketplace that these bailouts would continue to occur and that the government would step in and bail out almost anybody and everybody. And it also would have kept Fannie Mae and Freddie Mac from having become these, government-sponsored but private institutions that were then given the green light to trigger the bubble in the first place. So I think the bigger picture answer is we would have been far better off without it. I think within the microcosm of these events, there was little choice but for them to step in and provide the bailouts that they ended up providing.
So finally, Todd Sheets, where do we go from here? We have a new president. We have a lot of things happening which will be different in our economic markets as a result. Where is the path ahead for the United States of America?
We've got, as you said, a new administration with a very powerful mandate to make significant changes. I think as with respect to these issues, unfortunately, the lesson that was generally taken away, I think, in the academic, the historical, and the political communities was that this was a failure of a lack of regulation, when in fact the opposite was the case. And as a result, we've gone down a path where Fannie and Freddie still exist. They're now controlled by the government. I think the first thing would be to either completely privatize and break them up, or to dissolve them completely so that we don't have them coming back to play this kind of role again at some point in the future. And the second step would be to dramatically curtail the ability of the Federal Reserve to create asset bubbles, through misguided interest rate policies. We followed the 2008 financial crisis with a significant expansion of the Federal Reserve's mandate. They had a bigger regulatory role afterwards, and they started this quantitative easing program, which gave them the ability to influence long-term rates as well as short-term interest rates. And those have created other problems. We now have housing prices are very high again. Affordability is a major issue. I don't think we're necessarily on the cusp of a collapse because lending practices have changed, but we've got a new set of problems resulting from, another decade plus of, very easy monetary policies coming out of the Federal Reserve. So I think those are the two places to really focus on and institute changes.
Todd Sheets, if people would like to get a copy of the book 2008, What Really Happened, or if they'd like to follow your work online, tell us how, please.
Yeah, so the book is available on Amazon, or it's also available from Encounter Books, which is the publisher. I think the best thing if they're interested is buy and read a copy of the book. And if you like it, recommend it to a friend.
You've done a great job in making it understandable and making it make sense. Todd Sheets, thanks so much for joining us today on the Schilling Show Unleashed podcast.
Yeah, Rob, thanks for having me, and thanks for helping to get the message out about this. I really appreciate it.
That concludes another edition of the Schilling Show Unleashed podcast. Visit us online at schillingshow.com, where you can directly support this podcast by clicking on the Patreon banner at the top of the page and making a monthly donation. Your support is essential for the continuation of the Schilling Show Unleashed podcast. Until next time.